Hi, this is Randy Finney with Right Side of the Chart. This is a late morning session update for Monday, November 18th, 2019. I want to do sort of a potpourri mix, some of the different securities unrelated, some of the things I'm watching, kind of somewhat of a follow-up to the charts I'm watching today, and some general commentary on the market and where we might be headed. I'm going to start out here. This is kind of random. Again, I'm going to potpourri mix. I'm going to jump around to a few different things. This is E7. These are the Euro futures. I wanted to make a update or correction, which I actually did in the post this morning. On this morning, excuse me here, this morning's charts I'm watching, I had said that it hit my first target of 110.79. Then I realized that chart I put up on Friday, I had this target here. The first target at the time was 111. And I added that line on Friday, I guess shortly after that post, because when I went in this morning, I had that level there. Either way, neither here nor there. We now have hit, so just kind of an FYI reaction now is likely here. We had a reaction on that first level, and again, I just wanted to update that, and I did in the comments section. So that's I guess number one. And that would be, if you're, anytime I post a home page, front page post, you just click home, or this icon here, the site icon is going to bring you to the home page like this. We'll go ahead and do it there. That brings in all posts in the front page. This is, silver, gold members. This topic, these include all topics. Somebody had sent me an email the other day. They were new to the site, and they said, Randy, you have so many, categories and subcategories, market analysis, all asset classes. Well, that's if you want to dig in and find something. If you want to find analysis on gold, click gold. If you want to find analysis on the stock market, click equity market analysis. If you want to find Forex, fixed income, you get it. Or all asset classes, you can click that. Or just trade ideas. But when you click home, that's everything I'm posting, and that's just kind of things I'm seeing. That includes trade ideas, includes general analysis, and then of course if you are interested, let's go into the charts I'm watching today. Anything that I post here, I will post updates. I might miss something. I might see something else. For example, just go through this today. Somebody asked, okay, Randy, anything on the ES? You posted a chart of NQ. Remember, in the charts I'm watching, there's two reasons. I can't post 30 chart. I'm going to highlight a few things that stand out. To post ES, it's to not post IWM, it's to not post RTY. I mean, there's tons of different indexes. To me, it's all about tech, so I watch the tech-heavy NQ. I like to trade NQ because there's more bang for your buck. If you get the call right that the market's going to go up or down, let's say 5, 10%, whatever that number is, 9 times out of 10, if not 10 out of 10, NQ will rise more than the S&P 500, or NQ being the NASDAQ 100 futures, or it will drop more because it's a higher beta index. It's more concentrated into tech stocks, things like that. So they do move together, but you can look at it this way. NQ has maybe called a slight leverage factor, maybe a beta fact of 1.1 beta adjustment. So that's it. Now that's what I post. But again, sure, ES. Fine. Somebody asked for that, and I try to post these from time to time. So there it is. So my point is, you come in if I post something on the broad markets, and somebody requests an update on ES, absolutely. So I posted my target chart there. Somebody said it can't read. You can't zoom in on these. Yes, it's a different software that drives these post charts that get plugged in. If I or anybody else posts any charts here, but I mentioned just go if you're running any browser, you can just click to the hamburger icon in the upper right hand corner, and you can zoom in and out. So you can zoom in and out on a chart that way. That's easy to do. So that's there, and I made the answer there. Yes, SPY, QQQ, sure. I do these, several times a week. I'll do video updates or static charts, so you could usually go back in and find those. But again, I posted charts of SPY and QQQ here. And again, like I said, this video is somewhat off, different topics here, but I'm just going through how to most efficiently find what you're looking for. Somebody asked about NG, natural gas. I made mention, I did make a reply here, but if possible, let's try to keep the comment sections below a front page post on topic with what's posted there. So we have gold, I mentioned silver, platinum, and I also updated platinum and palladium. So I mentioned the other precious metals, so that's fair game. Hey, what about silver if I didn't post an updated chart, or you want to reference a chart, there's probably one from Friday or Thursday in there. So that would be on topic, a related topic there. And same thing with the euro. I posted the euro. There's that Friday's chart. Here's today's chart, and I think I just showed you we just hit that target now. My thoughts were there. But I've also, in recent weeks, highlighted the euro as a trade idea, and I said another proxy, you can short the dollar via UDN. That's an ETF that goes short the dollar, or just short UUP, or trade short dollar futures. There's a lot of ways to trade these. And again, so one chart here, I just happen to be kind of queuing in on the euro. But if you get the call on the euro right, you're going to have the call on the dollar right, because it's the biggest component. The dollar and the euro are going to move inverse because this is the largest component of the dollar index. So again, if somebody wanted to say, well, okay, Randy, can you give me a chart for DX, dollar futures, or UUP? Absolutely. So I mentioned that. I did provide an update there on nat gas. And again, so if you're interested in anything in here, just go to the subscribe feature right here. There it is, just at the beginning of the comment section, and you can either be notified if there's any new follow-up comments, or if all you're interested is a post that you made a comment, question, let's say to me, Randy, hey, can you post a chart of ES? Click that, and then if I do reply to you on that and give you a chart, you're going to have a link to that. You'll get an email sent to your inbox with the content of whatever my reply was, and I believe with a link back to the site to that part. So that's kind of, again, just tips and tricks on how best to use the site. All right, so that's that. So, and as you can see, quite a bit of activity, today in this one alone. I haven't caught up. I posted these charts I'm watching this morning right after that, right after the, and I'll do an update here on NQ in the markets in a second. Shortly after that chart was posted, we did break down. So you can see, and I'll get into this in a second. I just wanted to loop over to Friday's, the last update. I shut down over the weekend, and I haven't had a chance to come into the comments here from Friday, but I wanted to address this one. Member here had some suggestions, and listen, I welcome all kinds of feedback, especially contrary opinions. Suggestions. You have a different opinion, or you want to make a suggestion, that's fine. As long as we keep things civil, that's what this is all about. The last thing on earth I want this site to be is a bunch of everybody else with the same mindset, trading the same way I see, seeing the same things, using the same things I see, bearish when I'm bearish on something, bullish when I'm bullish on something, because then that just kind of, we all reinforce our own biases, and that's not healthy. But I did want to speak to this. So here's a quick suggestion. It seems as though much of your analysis is based on a perception of yours that the market is way too high right now and absolutely has to have a big correction soon. Okay, so if you listen to any of my comments, I've never said we have to have a big correction. What I'm pointing out are the things that I see, and I'm going to loop back here, and maybe I'll post a link to this underneath this video here. This is a post I made a while back. This is years ago, back in 2012 actually. Wow, gosh, time flies. All right, so this is on the site. Predictions versus warnings. I'm not going to read the whole thing here, but what I wanted to mention is I used an analogy here because back then, I guess at this time, I was seeing, as I am now, a lot of signs of non-confirmation, like I've talked about, the breakout being on unusually low volume, even lower than the volume drops that the previous corrections happened. Everything is bullish sentiment spiking, divergences, you name it. Everything I've covered. Again, I'm not going to get into that now. I've covered those ad nauseum recently. And so what that is I use the analogy of a tornado watch versus a tornado warning. Now, I live in South Florida. You can use this hurricane watch, hurricane warning. And so basically this is it. A tornado watch is issued when conditions are right for a tornado to form, while a tornado warning is an alert that warns that a severe thunderstorms with tornadoes may be imminent. There's a big difference. There's a difference. And again, so what we have and what everything I've been highlighting recently is simply comparable to a tornado watch. The conditions are in the market, many, not just one or two, a lot of the same conditions that we've had leading up to previous drops, including the big one that happened last year, last fall, and that was a big drop. And that's typically where your biggest drops come from, is when everybody all of a sudden there's a sudden shift. But again, it's not just one thing, it's all the conditions there. Now, take it a step further. A tornado warning, again, is when it's almost imminent. You have severe thunderstorms, just like a hurricane warning. I've been living in Florida my whole life. You see that big cone of certainty or uncertainty, whatever you want to call it, and you'll have when it's days away, possibly a hurricane watch. You're on watch and get ready. Maybe go down and get some water, bottled water, get some boards if you don't have hurricane shutters for your windows. But then when you get a hurricane warning again, it's more imminent. There's a good chance you're going to get hit. Get ready. So the difference on the stock market is we've been moving up, and I've made that crystal clear that the trend is up and there are zero sell signals. So again, going back to what I have levels that I've talked about. Each one, you break that, then you have to break the next one, and then there's final levels where I think, as I've been talking about, 8,200 on NQ. If that gets hit, it'll lead to a deeper correction. But again, at this point in time, the only thing I see in the charts with the recent bullish price action, everything else, is about a 3 to 4% correction. So I just want to make that clear. And if I haven't, let me know. Reply to a comment section if I sound wishy-washy. Now, I do from time to time, I loop back and I fully maintain these targets. I think I have longer term targets that I believe will play out over the next year or so of a drop, which can be now at this point as much as about 42% on the NASDAQ 100. But let me be crystal clear if I haven't been. I haven't done a lot of the long-term analysis. When I go back, there are conditions that I've been stating for months, if not years now. These are some of those. The primary trend line right here on QQQ. Here's our primary bull market trend line. That needs to break. We need to see a solid red candle. We have not seen that. This is a monthly chart. We came close there, but we closed right about on the trend line or right there above. And this 20-month moving average. These are just a couple. I have trend indicators down here. So until and unless my longer term trend indicators fire, I'm not issuing a warning on the market dropping 30-40%. In other words, it's priced into the technicals. I put it a high probability, and I would even give it a watch. We're on watch for that, but a lot has to happen first, and that's why I'm focused on the 60-minute charts. Okay, so I hope that's been clear. And then on that, let me just make sure there's one other point I probably want to talk about. Meanwhile, indexes like SOX and XLK are exploding to new highs with no end in sight. Well, there's never an end in sight. The market always stops from new highs. Not to be facetious there, but that's where all tops end. But XLK, by the way, SOX are just simply a subsector. SOX are technology companies. The semis, a subsector of XLK. And yes, and that is, again, that's what I watch, and that's what I'm talking about. And I believe on Friday, last week, I updated that, mentioning, hey guys, I showed you some trend lines that have broken on the indexes, but I was remiss not to point out a few of the top sectors, namely XLK. So if you were a member of the site back then, even not, I covered this on the YouTube channel. I did the same thing leading up to the big drop in the fall last year. Day by day, warning, just saying we don't have any sell signals. We're waiting. And I said your sell signal will come when tech breaks. I repeatedly said when tech breaks, the market breaks. That's simple. And when tech broke, XLK, QQQ broke, because QQQ is 50% or more tech stocks, and it's it's by far the biggest weighting in the S&P 500 at nearly a quarter. And it's that simple. So these are the things I'm watching. And again, this is a watch, not even a warning. You break it, you have a warning. If you break it with conviction, the strength of that warning, if you see a big red candle, maybe a big bearish engulfing candle or some type of island cluster top, some high probability candlestick problem, it's easier to put better odds. And then finally, so why are we not in this? Well, I can say this right now. I will not catch every trend, every stock, every move in the market. Not even close. I treat the stock market, although it's, the broad market, S&P 500 in itself is 500 stocks. You have thousands of stocks in the stock market. The Russell 2000 companies there. So there's many stocks, but I treat overall the stock market itself, whether it's SPY, QQQ, IWM, all of them together, it's just simply one security. We're not trading. Nobody here is buying all 500 stocks in the S&P. If you want to bet on the market, you're going to trade ES or SPY. I treat this as a security. A security is simply an asset that trades, on a liquid market. And I treat SPY no different from any other ETF or any other individual stock. And so what I'm getting at here is I'll move on if I don't see a trade. And this kind of goes back to when you guys ask me chart opinions. I don't ever try to force an opinion. I think I'm doing a disservice to somebody if they say, Randy, what do you think XYZ? And I say, oh, I think it's going up here. I'm bullish, bearish. If I don't have a strong read on the chart, I'm going to tell you. And I can tell you this now. I am a chart hound. I pour through hundreds, sometimes over 1,000 charts in a week, rifling through them. Most charts I look at, I can go through 100 charts and maybe at most 10, a dozen stand out as something where I clearly see something in the chart and I have an opinion. A lot of charts or the market, I just don't have a good read. And so don't mistake me not being long the stock market or not being long gold at a point where it's rallying for being bearish on it, or short. I just move on to the next one. I look for stocks that have very good risk reward profiles and more upside and not a lot of upside potential. Here, I'll give you one example here. Here's a trade idea. I started focusing on the shipping sector about a month ago. Threw out a lot of shipping stocks. Many of those were double. We might even had some triple-digit gainers in there, some of the ones I threw out. A lot of these are unofficial trades for several reasons. I took a shotgun approach, as I said, to the sector. I like to spread it around. There were a lot of names. And also, a lot of these are high risk. They don't make the cut for the official trade ideas. I try to avoid penny stocks, low-price stocks, things with excessive risk, because I know there's all types of levels of traders. And if it is a risky stock, I try to do my best to point that out and mention, hey, don't go crazy on it. But here's one back then, point out, and you can see I had targets here. You can see all the notes. Pending buy signal, first target 133, 156, and then 253. I actually updated that one in a video on October 16th because it did break out, and it just broke out again. This is what I want to mention now. Unfortunately, shame on me, I didn't have a price alert set this time. I had one back there. It broke out. It hit, that was right here was posted. Ran up there, broke out, and in one day almost hit that second target. It came 3 cents shy for about a 40% pop. But again, it continued. It went back down within that trend line. That was just a one-day spike. In fact, it never even closed. It was right about on it when I was doing the video, but it managed to close back down below. Here you can see, yeah, just right on there. Look at that, right on that trend line. Or just within it. And again, unfortunately fell off my radar, but again, this is what the type of stocks that I like to trade. And forget it, the stock market is up since it broke out the new highs a few weeks ago. I think the broad market is up 3%, 3.5%. This stock in 2 days just went up. And I hate to do this, guys. I really avoid hindsight analysis because it's annoying, number one. I don't like to hear anybody tell me, oh, I just took XYZ for a 30% gain. Booked it. Okay, well, thanks for sharing that. Why didn't you let us know before? I try to get things out in advance, but of course the stock was thrown out, but it dropped off my radar after that blip where it almost hit that target. But look, 72% in 2 days. It broke out on Friday. And the funny thing is, I think this stock has a very good chance, as long as the music continues to play in the shipping stocks, and it has. A lot of them have held up, and that's one thing I said about it. You need to see continued strength there. Another about 17% to my next target. May need to take a breather here. It may not. I've talked about these shipping stocks repeatedly in the past. I've traded them many years. When they want to run, they can run like nobody's business. Overbought can become way more overbought. And so therefore about 17%. And if my final target's hit, which based on the breakout and the volume, there's a decent chance there's another 90% upside from here. So again, I might not catch, the break. I might not be long the equity markets now, but here's the S&P 500. That's where it broke out right about 302 and a change, and it's up 3% since then. So if anyone that feels they're missing out, like I said, number one, I'm not going to catch them all. Number two, I've not been, not suggested to anybody, sure, we don't have any sell signals. If you want to take a shot, I do think the risk reward is favorable, but it would be a pot shot. That's what I call a pot shot trade. We've had those 60-minute trend lines break, but as I did in the update on Friday, those key sectors, healthcare, tech, those haven't broken down. And then more importantly, I've been hyper-focused on the NQ 60-minute chart. So here's an update. After this morning's post, so we'll kind of get back to the markets now. We broke that trend line. It was impulsive. We hit that level, and I didn't expect much to react, and I still don't. It's a little more than what I thought we'd get now. And so I wanted to convey my thoughts here in the video. This is how I trade. I assess the charts as they go. I was expecting to see a very little, if any, of a reaction and just a continued move down here. But so far they stepped in and bought it. So that tells me, at least at this point in time, there's still a little bit of oomph left, and maybe a lot more. It depends if this keeps getting bought up. If that's all we get on that breakdown, especially after the back test, because here's the thing, this back test is getting a little bit long in the tooth now. I'm going to extend these divergences, as I should. We still have the divergence, but we broke down here. We back tested once, immediate back test, but then back tested there and back tested again. From my experience, this is about as healthy and as a normal back test you get. If you keep walking up this line, I have seen it happen where you walk up for a lot longer and then you roll over. But ideally at this point, with the divergences where they're at, we should move down here. Otherwise, there's just a very strong bid in the market. So as I've been saying now for at least this last several weeks, we really, to open the door to these targets that I have down here, the 80-40, 80-50 level, and now my, like I said, I'm leaning more towards this 79-78 target being hit. So we'll call that my preferred swing target zone. We're going to need to take out 8200. And now, if and when we start to get there, I will communicate my thoughts. My current plan is to ride that down short to that level and reverse. But again, that's just a kind of a rough plan that will depend on how the charts look. How does it move down there? If it even happens soon, how does it look? Is it like this? Is it, would we work our way down? When we get here, do we have, I'll look at the 5-minute charts, the 1-minute charts, 15-minute charts, 60-minute charts here, daily charts. Are we setting up for divergences? Does it look like we have a near-term selling climax? Because at that point, I will make a decision if and when we start to approach these targets to either cover and just sit tight, let the dust settle. Sometimes I'll cover in reverse, cover short, go long, or quite often, if I think there's a potential for more, instead of covering, let's say we're on our way down here to 79, we break this 80-40 level, we're coming down here, and that would my preferred near-term target. At that point, I may just set stops, tighten my stops up down here, maybe somewhere above here, and allow for a break of that level and a drop of much more, because if we get down there and we go much below that level, we will have a failed breakout in the market. So although you're seeing a lot of updates on this 60-minute chart, I try not to ever lose focus of the bigger picture. And the bigger picture to me says if QQQ drops much more than much more than 4%, we'll call it, we'll allow for a little dip below the previous breakout. The S&P 500, also, there's your breakout. About not much more than 3% or so, a little more than 3%, right about 3% to the highs. And you allow for a little bit. They break that, they break a trend line. That would then be a failed breakout, and that would be quite bearish to see a failed breakout to new highs, especially at this point, especially with how quickly and sharply we've shifted to very bullish sentiment in just a matter of a couple weeks. It seems, and I haven't seen such a quick reversal in sentiment in a long time, where we went from a lot of recession fears, a lot of bearishness, to extreme bullishness, and just across the board from what I'm reading and hearing, everyone is just like, this market's going much higher. It sounds like everyone's, the FOMO trade is like in full swing right now, fear of missing out. People are much more afraid of missing out on some huge year-end melt up in the market than they are being caught on the wrong side of things there. So again, I'm sharing my thoughts, and I may speak the bearish speak or speak the bullish speak about gold or something else, and that doesn't necessarily mean, and I'll communicate my thoughts. You ask me, I'll tell you if I have a position. That shouldn't matter. This is not a follow me site. I'm in and out of positions. I also hedge. So, for example, I mentioned today that I'm short palladium, but I'm also long gold and silver, and that's somewhat of a hedge trade. It's doubtful that they're all going to play out. It is possible, but I made the case, for palladium short and been short that for a while. And as I said, I'm, bullish on near term. Bullish on gold. I posted the update this morning, the charts I'm watching, saying that's probably the first corrective wave. If you recall, in one of the recent longs on natural gas, when I went back to the daily chart, I showed you have a breakout. We had a similar pattern here on natural gas. This is going back a couple months on the daily chart on natural gas, but I showed we had a breakout with an initial leg up. It's usually you're going to get a leg up and then a correction. At minimum, you get an ABC corrective wave. This is in a downtrend right now, at least intermediate term downtrend. This is gold, and but to play this, and that's why I thought, this morning I put out the charts I'm watching. I think that was an objective buy point. So far it is. You had a nice rip in gold right after the charts I'm watching was posted. The market dropped, and again, it's all kind of interrelated, and so therefore, like I said, that's the point I'm trying to make there is. You may ask me, if I'm still short palladium, and yeah, if I say yes, I am, but I'm also kind of hedging my bets this way because palladium is a precious metal, but I'm open to the possibility that gold and silver could rally and palladium turns down. For both the technical case, because I've made a case on the palladium, lately, I'm still, as I've tried to communicate my thoughts, there's a little hesitation before I consider this as an official trade, based on everything that's going on, and also up to including and not limited to my expectation that we're probably going to see a correction sooner. At least the odds are very high for a correction and pullback in the market. And if so, that gives you a spurt or a burst into the risk-off trade, which are treasury bonds and the precious metals. And birds of a feather tend to flock together. But I have in just recent videos showed you there are periods where palladium and gold can move inverse of one another. And again, palladium, although technically speaking is a precious metal, it has more industrial applications. So if market pulls back and there's a little more worries about the economy, you could see palladium fall based on fears of declining auto sales or things like that, which drive the biggest demand for palladium. But yet gold catches a bid not on its industrial applications, because gold, although a precious metal too, has tremendous industrial applications, as does silver. But gold will get that more of a flight to safety bid. People don't say, oh, bear market's coming, I'm going to put all my money in palladium. No, you hear gold bugs want to buy gold, just like Bitcoin people want to buy Bitcoin. So palladium, again, more of a, like I said, hopefully that makes sense. But again, it's to me, it's all about hedging your bets, diversifying, but then doing that not just solely to have two counterbalanced trades, or potentially, but more so because the bearish technical case can be made for palladium right now. Gold, I'm in near term unsure, still not very sure of the near term direction. I don't know how anybody could be. It's in a trading range. You must be a wizard if you can make heads or tails, out of this chart. The gold, in the last few months. To me, it is. I don't think anyone can argue. It's a consolidation. It is a slightly downward sloping level, but it also appears to me to be, and it meshes with my longer term analysis on gold, seems to be a breather, taking a leg within a bull trend, and most likely to go this way. But I'm not married to that scenario, nor will I be fully invested in a long-term swing trend position until gold clears that level, and ideally that level there. I've been accumulating, but I'm very, as you guys know, an active trader. Just right now, been long gold recently for the case I've made for gold and treasury bonds over the last week or so being oversold at support, and then also the market getting a little frothy. And So it's also, a way to, hedge maybe some index positions on the market. Okay, and just to loop back, I don't want to, completely dissect this post, but there's just I just want to clarify if anyone's new to the site that I've never ever talked about, or nor do I think. In fact, I've made very clear if you go back this year, I think the next bear market. I'll just call what it is. The next bear market will be very different from 2008. I am not looking that we don't have the risks in the system right now that we do in 2008. So I've made very clear in some of the longer term videos in the past. I think it'll be a long drawn out. I think we're in a session, a period, and a technical and fundamental setup much closer to Japan. Pull a long term chart of the Nikkei, go back to the early 90s, the beginning 1990, and do a Google search on the term the lost decade Japan. Type in those words, lost decade Japan. You will read about their nearly identical situation. They had a credit bubble burst. They met that, both the real estate market and credit markets popped there back in the beginning of the 90s. They met that with quantitative easing and zero interest rate policies, and then you can read up on that and you can see where their market goes. Now, within there, they were entered a huge secular bear market, but there were huge, powerful, and very lucrative and obvious, in the charts, bull markets to trade. And I love trading. Find a bull bear market, doesn't matter to me. So I just want to say I've never talked about, and if you've heard otherwise, and if I'm not clear, a 2008 style collapse. Not talking about that. It is possible. Anything's possible. Melt up right now is possible. Something like the .com bubble, it's possible. I don't see it in the charts, nor do I see a 2008 style collapse. I just want to make that clear. So, whatever. I'll share my thoughts on the market, and that's that. And you guys do what you want. At the end of the day, don't follow me. Like I said, this is not a follow me site, and I do technical analysis on the stock market. And by the way, that's public content. That's free. The stock market is a tough pony to call. It is thousands of stocks. It is much easier for me to find an individual stock or commodity or even a sector, because those respond better to technical analysis. You have the broad market, it's controlled largely by inflows. There's just so many variables, so many different stocks with different sectors in there. And that's, broad markets, it can be, at times, I can call it very well, but overall it's a tough cookie to call. That's it. So I, prefer to focus on the individual stocks with clear setups, especially those that are not heavily indexed, because they're going to move with the market. Your Apples and Facebook and Amazons and those. All right, we'll try to wrap it up here. So that's that. So these are the things. I didn't include Treasury bonds. I thought, but I did the update in gold and I shared my thoughts on the market. And remember, gold and treasuries they're the risk-off assets. So in the charts on treasuries, and the price action recently has been very similar. We put in the divergent low recently in treasury bonds. There's your divergence lines right there, and we've been moving up, kind of almost not quite a W pattern, but close to it. But you can see we're up to this. We've hit this level now. So 159. I've talked about it quite a bit. We hit it there. It's been one of the key targets. It's a pretty important support level. So based on this, and my outlook for the market, if we can break down, take out 8,200 on QQQ, I'm sorry, on NQ, take out those uptrend lines on the indexes, the sectors. I'm talking XLK, the financials, healthcare that I just covered on Friday. Get those a little bit more downside that I'm looking for, that I think will be the spark for that correction. Then treasuries, I think you have another leg up, just like gold and everything else. I think you'll see. And I think this trade, like everything gets a little overdone to one side or the other. When there's a sudden shift in market sentiment, and that's what's happened, all of a sudden everybody's flocking out of the risk-off assets. They tend to get a little overdone to the downside, just like the stock market gets a little bit overdone to the upside, at least a little too much too fast, and then you have your correction. So that's it. Right now, that's all I'm looking near term for these, like I said, maybe 3-4% in the equity indexes, maybe comparable moves here on the risk-off assets. Little more work to be done, and that would be those levels I've highlighted, like 8,200 on NQ. Right here, for example, you want to see 159 break on ZB. But this stuff is not so straightforward. If you're a ZB trader, ZB or TLT, by the way, TLT is the ETF for this. I know I cover futures a lot. I'll try to make a point to give you those comparable targets on the ETFs that track. But just a takeaway from this: if ZB, let's say today, broke above 159, but at the same time NQ does not break below 8280. It hit that 8281. It hit that level this morning. That was my first target. Like I said, I thought we'd have just a very brief reaction, if any, and then going down. But so far they've stepped in and bought it, and that shows you until and unless 8281 or 80, we'll call it 8280, until that level goes, they're showing you they're buying any little pullback, any little dip to support. So back to ZB. You want to increase the odds on a breakout of that 159 level on ZB, or if you take TLT, either way, what you want to do to greatly increase your odds of that breakout sticking and not failing is you want to watch NQ, even if you're not trading NQ, because if ZB breaks above 159 and NQ drops below 8280 around the same time or shortly afterwards, I would say the odds go up manyfold that NQ will come down here and then ZB will shoot on up to the next target. Otherwise, ZB breaks out and we pull back here at the same time, another test of 8280, and it's a successful test, and the stock market does this. Well, guess what? Going back to ZB, that will probably be a failed breakout for the reasons I mentioned before, because these are, right now, closely watched trades. Everyone is trying to figure out which way the market's going to go, and so if Treasury bonds were to break out, doesn't guarantee they'll fail if the market reverses, but it certainly increases the odds that it will. Okay, let's wrap it up there. I was planning on hitting on a few more trade ideas, but that's it. Like I said, a big part of this, I want to kind of communicate my thoughts to those on the site. And please keep the, in the comment section coming. If you disagree with something, post. Oh, and one more thing on that, just to beat a dead horse, but it's important to loop back to it. Again, there are, as I said earlier, I don't, in every single chart I look at, I don't see anything that clearly stands out every time. I don't have a clear opinion. I do have an opinion that I've been sharing on the market what I think will happen, but also if it's not my kind of breakout, not my kind of chart pattern, I won't take that. And if it were, let's say it were, where my skill sets lie is identifying support and resistance levels that are the salient levels. You can look at a chart. It's like an ink blot test. Everyone's going to see something different. But for example, today, that was my level. That was the first level. We hit that level. This isn't mere coincidence that's where, after the sharpest drop that we've had now, you can look back, and that was probably the biggest leg down in at least a week, maybe weeks. Maybe even a couple months, and boom, we hit it in reverse. So that's where my skill set lies. Now and this is one reason I love trading corrections or stocks that are bottoming and look to go up, because you have these levels. You have trend lines right now to trigger objective short entries. You have levels to cover shorts or reverse and go long by the dips. But guess what? When a market or a stock or anything breaks out to new all-time highs, you have absolutely nothing. There are some tools out there in TA, such as Fibonacci projections. Oh, no, I had to turn my drawings on. I was going to throw up a Fibonacci projection line. Never mind. Yeah, you've got several points, and now I got to get rid of that line. All right, let's just move on. I threw one up there, and you got to drag, a couple things there. Fibonacci projections, Elliott waivers can, project with counts where you might go. But other than that, there's really no overhead resistance. There aren't any overhead resistance levels in which to target, and sometimes if there's a breakout to new high, if the pattern is such, if it's conducive, you can project. For example, if you had, I'll give you an example here on SOX a couple years back on the weekly chart. I know we had a where'd it go? What was it? Maybe on the daily chart we had a big triangle pattern. I must have it on SMH or another one. And things like that you can project. If you have a clear pattern, I must have taken it off. Let's say head and shoulders, a symmetrical triangle, a descending triangle, a broadening wedge pattern. A lot of those patterns will have a projection or a measured target where I then can look at an upside, look at a security and say how far might it go? What's an objective level to target? But in the case of the recent breakout to new highs in the market, it's been a marginal new high, and it wasn't out of, we had a wedge breakdown there that just didn't pan out so far. And again, there's nothing that I see. Maybe somebody else sees something. I don't see any objective reason to go long. It's a breakout, one that I suspect will fail, but I also don't see any price targets. And I've said this too, if you are bullish on the market, and you feel you're missing out on this trend, there is nothing wrong with buying today, buying Friday, buying next week, and riding that wave up as long as it lasts. And all you have to do is set a stop and trail it up. And that way, if we do get that reversal, it's not the end of the world. As long as you have a stop, it may get gapped beyond. You have to be careful. If they gap past your stop on a big gap down, we could keep falling. That's one thing. But other than that, that's really the only way to play a trend. If you feel you're missing out on a trend, if you feel there's a lot more upside, buy the market if that's what you want to do. And like I said, just don't fall in love with the trade. Raise your stops from time to time to protect your profits, and maybe there is another 20-30% upside in this market before we drop 10 or 20%. It's possible. It's just not the way I see it. All right, we're going to wrap it up here, and I'll get some other additional trade ideas and updates out to you guys as soon as possible. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.